Oh, Dave Ramsey. You either love him or you hate him. Well, hate is a strong word, but maybe you agree with him or you don't agree with him.
Everybody's all worried about everybody's feelings these days. I'm not worried about your feelings. I make a living hurting your feelings. I don't give a crap about your feelings.
That's harsh, David. But I feel that sometimes. I like a lot of what he's done for people and in the industry, but I also disagree with a fair amount of his outlook. He's great for getting people out of debt and great for teaching the basics of learning how to save. His investment methods are a little bit outdated, and so increasing wealth is not necessarily his strong suit, but this video popped up recently and it's from an interview he did about a year ago. He's known for advising people to go into mutual funds and for advising people to pay off all their debt and to pay 100% of the house price and just pay it all off in cash. While I agree that if you do have the opportunity and are blessed enough to be able to pay off your primary residence 100% in cash, then that would be awesome. But I also live in the real world with very inflated home prices these days, especially since COVID, and so I kind of like to stick to reality. Now, ETFs and mutual funds and index funds all kind of sound similar, but also different. Many people on this channel ask me which one should they invest in versus all the three. Historically, Dave Ramsey's been a big believer in mutual funds over anything else, so let's see what he says about the difference here.
ETFs, and I have no idea, or I hadn't heard what that was. He explained it to me, and it sounds very similar to a mutual fund, so I was just wondering if you could clarify what the difference is and why a mutual fund is better than an ETF.
I don't know that a mutual fund is better than an ETF. ETF just means exchange traded fund, and for purposes you would use it for, they're very, very similar. They're almost identical.
So basically, these types of funds are very similar. They're basically a basket of stocks all wrapped together in one, so if there was a technology-specific ETF or mutual fund, it would be one that has Amazon and Apple and Google and probably Palantir and Nvidia. If you're a long-term investor, you can invest in any one of these, either an ETF or a mutual fund or index fund, and you probably won't even notice the difference between the three as far as long-term. Usually you just pick whichever one's more convenient or that you like the holdings, especially in the top 10, but you should especially be looking at the fee. The fee is what sets it apart in my opinion. There's also many important factors like is it actively managed versus passively managed and looking through taxes and different things like that, but for now and generally, they're very, very similar. You definitely want to save money in picking the best fund, but it's also pretty cool to actually make some extra money doing something pretty sweet and having fun. So I wanted to show you this way that so many people are making some extra side cash playing some video games and filling out surveys. Thank you to FreeCash for sponsoring today's video. FreeCash is an online platform where users from all over the world can sign up for free and make money online by playing mobile games from different categories. I checked this out and FreeCash has 4.7 stars on Trustpilot, which makes me very happy. This month, users cashed out over $542,000 just by using the FreeCash app. Sign up, play games, complete surveys, and tackle simple tasks. You basically get paid for what you'd anyways be doing for free. I actually really like this Goods Master 3D game, and it was actually pretty fun. I built up to $20 in my account pretty quick. Once you make your money, you can withdraw it super easy with a bunch of options like Stake or PayPal or directly into your bank. The whole process is seamless and very easy to navigate. Try out FreeCash for yourself by clicking the link down in my description or by scanning the QR code, and you're gonna get a $5 bonus on your first offer started. Now, depending on your country, your interface might look slightly different, but the functionality is the same. Check out FreeCash today. But like I was talking about with that fee, like the Vanguard ETF that tracks the S&P 500 is called VOO, and it has an expense ratio of 0.03%, meaning for every $10,000 invested, you're paying $3. In the State Street Fund SPLG, that one also tracks the S&P 500, identical to VOO, but this one has a fee of only 0.02%. Then if we look at Fidelity's mutual fund that tracks the S&P 500, called FXAIX, it has a fee of only 0.015%. So of these three options, this mutual fund actually wins. Sometimes mutual funds have much higher fees and sometimes certain ETFs have super high fees. So it's best to keep that in mind and do your research and always check. So back to this whole ETF conversation. Dave Ramsey doesn't like something in particular about ETFs.
You know, typically what people will do for an ETF is something like an index fund, like an S&P 500. And so it'd just be a group of stocks in there. Now, sometimes brokers will try to get you to buy and sell in your portfolio a lot, and they like an exchange-traded fund for that better. And so if you're setting it up to do, like you'd set up a brokerage account to buy and sell stocks in, I would not use it for that. But if you're using it like a mutual fund just to buy and hold, you're going to find it's almost identical, that you're not going to notice any difference in the practical use of it. So sometimes I hear things like, well, Dave Ramsey's against ETFs. I'm not against ETFs. I don't mind. What I want you to have is a diversified portfolio. Mutual funds, ETF, is either one of those will give it to you. What I don't want you to do with an ETF is start buying and selling all the time.
Now, I agree with this very much. The best way to use ETFs or mutual funds is definitely not to be buying and selling out of them over and over. They should not be traded in and out. I see too many people buying an ETF and then in 2 months they say, oh man, it's down 2% and this other one's up 5% in that period, so I'm going to switch to that one. That's a terrible strategy and it'll almost always result in a net loss. Don't do that.
And I don't want you to use any vehicle of investing that prompts you to constantly be jumping in and out, jumping in and out, jumping in and out. Because every time the news is good, by the time the news is good on the stock market, you're late. You should have already been in. By the time the news is bad, it's already too late for you to get out. And so people that try to jump in and out based on the news, and you're not saying that, Deborah, I'm just saying, but in general, if you're trying to use an ETF to time the market, we call it, then that use is not something that, that we would tell people to do ever. Because I don't time the market. I just buy and hold.
Buy and hold. The data shows that by holding an ETF that has broad diversification and has a low fee, especially one that tracks something like the S&P 500 or the total US stock market, is definitely going to be very, very solid for your portfolio. It has withstood the test of time through recessions and market crashes and global pandemics and surges back to all-time highs and further.
Because I'm not anti-ETF, I'm anti-timing, and I'm anti-constantly trading.
Because it's effectively gambling. If you try to play the market, you can really
You're
get
no
burned
longer
quickly.
investing, you're speculating.
That's correct.
ETFs are a very powerful way to invest. So are mutual funds. So are very solid blue chip stocks that have a very good competitive advantage and have a history of being a solid company. The main point that I wanted to get across in this video, and it's kind of the same thing Dave Ramsey was saying as well, is that we need to keep in mind why we invest. We need to keep in mind that why, not just the what. When you're investing in something like a broad-based ETF or mutual fund or something of that nature, you're holding it to hold forever, to hold for a very long period of time. As a long-term investor, you're investing today for what it can grow to tomorrow. So yes, there may be a year or two that it's down a little bit or it's flat or sideways, but we have to understand the why we invested in it in the first place. And if that still holds true and that fund can do what we expect it to do in the future, then just keep investing, keep holding, and stay the course. Remember to check out free cash with this QR code or the link down in my description. Remember to keep doing your research and find the best ETF or mutual fund for you. Then watch either of these videos to keep you going strong in your investing journey, and remember to keep investing simplified.